In the mid-1990s, the United States entered a rare moment. Productivity was rising, inflation was low, capital was cheap. The internet appeared inside this stability. It promised something radical: distribution without factories, scale without inventory. Investors did not see companies. They saw networks. The logic changed quietly. Profit was no longer required now. It was expected later. If a company grew fast enough, revenue would eventually appear. That assumption became the foundation. Between 1997 and 1999, venture capital flooded Silicon Valley. Companies with no earnings went public. Some had no finished product. Some had no plan for profitability. Valuations were justified by traffic, by users, by eyeballs. Traditional metrics still existed: cash flow, margins, balance sheets. They were not abolished. They were ignored, because capital believed growth itself was value. In March 2000, the Nasdaq passed 5,000 points, more than double its level from 2 years earlier. Technology stocks dominated the index. Companies like Pets.com and Webvan burned cash openly. Advertising replaced revenue. Expansion replaced sustainability. The system rewarded spending. As long as prices rose, losses were forgiven. Growth delayed accountability. Then the environment shifted. Between 1999 and 2000, the Federal Reserve raised interest rates 6 times. Capital became more expensive. Investors started asking old questions again. When will this company make money? How long can losses continue? The answers were unclear. Confidence did not collapse at once. It thinned. When prices fell, funding stopped. Companies built for growth were not built for survival. They had fixed costs, marketing contracts, office leases. Without new capital, they ran out of time. Between 2000 and 2002, the Nasdaq fell nearly 78%. Trillions in market value disappeared. Most companies did not fail suddenly. They expired. The internet did not fail. Technology did not fail. The system failed to distinguish growth from value. Markets remembered an old rule: growth explains nothing unless it pays for itself. The dot-com crash was not irrational. It was corrective. And systems only remember corrections. Until conditions change again,